Okay, here we are with problem exercise 8-20. Let's see. So during August 2015, Majid company recorded the following. So they had sales on account, cash, collections. They wrote off some receivables and they recovered some receivables that were previously written off. And they want us to do the recording of these things under two different methods, right? And remember, the direct write-off method is okay if it's not significantly different from the allowance method, but it's preferable to do the allowance method. That's really the generally accepted accounting principle way of doing it. But we'll do direct write-off first, okay? So sales of 57, and they were broken up between cash and receivables. So you would have sales revenue of 57,900, and the cash piece would be 13,900, and the amount that would be booked on account is 44,000. Don't forget to give it a description. Record sales for the month. Okay. So you got receivables increasing and cash. Now we collected 31,100, so cash is going to be debited for 31,100. That's the collection of cash. And accounts receivable is reduced using a credit for the same amount, 31,100. So record our collected cash on account. So far so good, yeah? Question? Not yet. Okay. Now it says wrote off uncollectible receivables 1,060. Okay, so that's going to go straight to bad debt expense, and we're going to credit accounts receivable. This is what we mean by the direct write-off method. The bad receivables are written off, taken off the books directly against bad debt expense. Right? Now we recover, or there's a recovery of receivable previously written off, which is 700. So we got to reinstate the receivable. So we'll put it back into accounts receivable and reverse the bad debt expense for just 700 though, not the full 1,060. So that's kind of a reversal of the thing we did before, but not for the same amount. So this is reinstating the previously written off accounts receivable.
Why is it only like a portion of it again? Sorry.
Well, they tell me. You see the sentence? They recovered receivable previously written off of 700. Okay. So it didn't require me to go in and figure out how much was reinstated. They came right out and told us.
Oh, okay.
Yeah. So I just went with what they said. Now we got to show the collection, because usually when you recover a receivable like this, it's a check that comes in the mail. You had already written this thing off thinking that you're never going to collect it, and all of a sudden you get a check from your customer. So the third step, well, the second step in the recovery is to show the collection. So it seems kind of silly to make the receivable go up and then take it right back down again, but that leaves a trail. Right? It actually shows what happens, okay? You couldn't, right? If you just booked it to cash, you wouldn't have an account to book it against.
So you always want to end with cash on account, collecting cash on account basically.
You want to end by collecting the cash on account. Because if I skip this step here, I wouldn't have anywhere to put this credit. You see what I'm saying?
Yeah.
Because we already recorded the sale that relates to it. So we couldn't double up our sales. So we needed to put this receivable back on the books so we have something to credit when we get the cash. Okay? All right. So that's the direct write-off method. It's not generally accepted accounting principles. But it can be allowable in certain situations. Now we're going to do this under the allowance method. Well, to tell you about the allowance method, it's going to be the same for a lot of the transactions. I'll show you where it's different though. So the first transaction will be the same. Okay, we're going to have sales revenue of 57,900, which is broken up between cash and accounts receivable. So exactly like what we did above. All right, and to record sales for the month. Okay, and then we collect, so that's going to be the same because there's nothing involving bad debt at this point. So we collect 31,100. Okay, collections on account. Okay, now we write off uncollectible receivables, 1060. In the allowance method, what we do is we're going to write these accounts off against the allowance for bad debts. Okay, and we would have set up an allowance prior to this. So these accounts get written off. Okay, against an allowance that had been set up prior to the whole write-off situation. Okay. So what happens is when we get this money returned, the 700, we have to reverse the entry that we did above. Okay, we're going to put it back into receivables and increase our allowance again. So we're reinstating the previously written off receivable. And then finally, the last entry will be just like the direct write-off method, cash and accounts receivable. The problem is okay. It doesn't get into how this allowance got set up, right? So really the only difference would be these two entries. But there's a way for this allowance to get set up, which you can read about in your chapter. Okay, let me see here.